Hello everyone. Trying to beat the S&P 500 feels like chasing a unicorn. Risky trades, only growth stocks, and way too much stress. But there's actually a simple strategy that gives you the best of both worlds. Solid long-term growth and the chance to outperform. And you are probably already practicing it to some degree. You just don't realize it yet. Now this strategy, it's called core and satellite investing, and it's way easier than it sounds. In this video, I'll break down how it works, how to build your own version, and why it might be the smartest move for everyday investors. Core and satellite investing is a hybrid approach to investing. A lot of common investing advice is 100% index funds, 100% individual stocks, but the core and satellite strategy is a hybrid approach that takes the best of both worlds. Index funds create the core of your portfolio, which is roughly 50 to 80%. But the individual stocks, that's the key. Those are your quote unquote satellites, and that will create 20 to 50% of your portfolio. Now, the advantages of this strategy is that it has the stability of index funds. You're not 100% in individual stocks. And more importantly is that it makes picking those individual stocks, those satellites, simpler, as you only need to look for the most obvious buys in the market. Again, the index funds are there to minimize the risk, to reduce the downside. But to beat the S&P 500, you do need to invest in some individual stocks. That is how you outperform the market. So why is this strategy so easy? As I said, it is the easiest way to beat the S&P 500. Many investors have a certain amount to invest each month. This might be $500, it might be $1,000, but it's a set amount each month. The hard part is that not every month you feel confident picking individual stocks. Some months the market is really high, or your favorite stocks just went up, and you don't want to buy at the wrong time. Now, the core and satellite strategy means that if you have an obvious stock, one that is a great company that's undervalued and that you are confident will outperform the market in the long run, great, invest in that company. Buy that individual stock and either add to a current satellite or create a new satellite. Otherwise, don't think too much about it. Just invest that monthly amount into an index fund. So as I said, the key to this strategy is identifying those satellites, identifying those individual stocks that give you the opportunity to outperform the S&P 500. And in the core and satellite strategy, you really want to focus at the bottom, those few companies. These are the preferred stocks that you're looking to add as satellite positions. Now, if it's a good company at a good value, that could be a possible stock. A lot of times those will additionally outperform the market. But most importantly is you're ignoring 90, 95% of companies in the market. And this is part of what makes it an easy strategy, is you don't have to look for every little stock. You're not looking at micro stocks, you're not looking at small cap. You're really only looking at the 20, maybe 30 companies that you know are great companies. Now, when you're looking for individual stocks, you really want to identify stocks with what is called asymmetric risk. This means that the probability of the stock going up is significantly higher than the chance of it going down. Now, these stocks that have a low chance of going down often have a very good chance of beating the S&P 500. In my opinion, the best method for finding these stocks with asymmetric risk is to have a list of research stocks, have a watch list, and when these stocks dip, then you reevaluate and you can jump at the opportunity. It's not trying to say, I have $500 and then start your research. You want to have already done the research in advance. But remember, you only need to really research 20 companies, maybe 30. So it is a reasonable amount of work, but it is not as much work as trying to do 100% individual stocks. Now, what does this strategy look like in practice? So here's an example. Starting in 2024, at the end of each month, if there just aren't any good individual stocks to invest in, then you just invest in an S&P 500 index fund. This could be something like SWPPX through Schwab. It could be VOO or VOO through Vanguard. And so you'll see here that for the first 4 months of 2024, you couldn't find any great stocks at a great value. So you just invest in an index fund. Now in May of 2024, CRM, which is Salesforce, dropped 20%, and that was one of the companies on your watch list. And you decided to jump at the opportunity and buy it at $234. Now, if you follow this month by month, some months you'll buy an individual stock that you think is at a great value. Other times you'll just buy an index fund if you don't see any obvious buys. Now, I'd like to note that these stocks in bold here, these individual stocks, match the actual stocks and dates that I bought. You'll notice I only bought 7 months out of 18. That's less than half. Over 60% of the time, I just bought an index fund. And so really, as we look into this, the key is identifying those individual stocks and when to buy them. So going one by one here, you can see Salesforce in May of 2024. And as I said, in May of 2024, Salesforce dropped pretty significantly. It was close to 20%. And that is when I bought right there, not quite at the bottom, but as it started going back up. And you'll see since then, the S&P 500 has gone up 17% and Salesforce has gone up 16.6%. So it's essentially matched the market, but it didn't deliver any outperformance. And that's okay. Not every stock has to outperform. Now, the next stock I bought was Visa. And this was one that I had really been looking at for a long time. As I said, it had been on my watch list for quite a while. And even though it didn't have a giant dip like Salesforce, it did see some just general laggard performance for 3-4 months, just slowly going down. And so when it finally dipped 3 or 4% within a day, I decided to buy right at that little small bottom there. And I got really lucky. As you can see, that was the absolute bottom over the last 18 months. But whether I bought there or a little bit after, a little bit before, it wouldn't have significantly changed the fact that Visa has gone up over 35% in that time period compared to the S&P 500 only going up 13.7%. Now the next one, the very next month in August, was Booking. This was another company that I've been looking at for a while. And it started going down really for no reason. And so again, I didn't buy at the absolute bottom, but I did buy after the second large dip in the manner of a few weeks. And this has actually been my best purchase to date. Booking has gone up over 70% in the last year compared to the S&P 500 only going up 15%. Now, Google Alphabet is a company that I've long admired. It hasn't had the best performance in recent times, but I do think that it is undervalued. And you can see even though it hasn't done great, it's only gone up 5% since the November purchase and 7% since the purchase a few weeks ago. It has still outperformed the S&P 500 by a few percentage. And this is really what you're looking for. This is the ideal case where you're not looking for the ones that do 2 times or three times what the market does. You're looking for just a few percentage here or there. And then the last individual stock was Amazon, and that was purchased during the April tariffs. So originally it was actually in March. Again, not at the absolute bottom, but after it had gone down quite a bit. And then I added more at the beginning of April after the tariff news. And you can see in both cases, it's gone up more than the market. Now, looking at the individual performance of these stocks, you can see that 6 out of the 7 stock picks, that's 86%, are outperforming the S&P 500 over the time period between when they were purchased and the end of June. And this is really what you're looking for. Again, you're not looking for every single individual stock to do better than the market. But if you're truly confident, if these are obvious buys, then over 70 or 80% should outperform the S&P 500. That's what you're looking for. Now, in this case, the core and satellite strategy went up 17% compared to the S&P 500's 11.5%. Now, again, that is not huge outperformance. It is really only 3.5% annualized compared to the S&P 500, and that's over a short time period. But the key is those few percentage added up over years and years is huge. Now, looking at it in comparison, if you invested in the S&P 500 and received 7.3% over 35 years, assuming $1,000 a month invested, you'd have 1.9 million. Now that's great. That's a lot of money. That is more than most people ever see in their lifetime. But 1% better, just 1% better at 8.3%, and you're almost $500,000 wealthier at 2.39 million. Now 2%, you're up to 3 million. And if we were able to maintain this outperformance and get 10.8% over 35 years, you would over double what you would get investing in just the S&P 500 index. As I said, small percentages of outperformance make huge differences in the long run because it does compound year over year. Now, the key is that the core and satellite strategy maintains a large base. That core keeps the portfolio from dropping significantly, or at least dropping more significantly than the market. And if stocks are selected wisely, you can over double the value of just investing in the S&P 500 while minimizing that risk. So that's the core and satellite investment strategy. It's a simple, flexible strategy that lets you stay grounded and take smart swings for growth. Only the obvious buys. You don't need to predict the market. You just need a solid core of an index fund and a few very high conviction stocks. If this helped clarify your investing strategy, give it a thumbs up and subscribe for more practical ways to grow your money. Got questions? Drop them in the comments. I read everyone. Thanks for watching.